Today, we're diving into one of the hottest debates in the world of investing: real estate versus stock market. Which is the better investment? We'll break down the pros and cons of each, analyze risks and returns, and help you decide which option suits your financial goals. So, whether you're a seasoned investor or just starting out, stay tuned for some valuable insights that could shape your investment strategy. Let's start by comparing the pros and cons of real estate and stock market investing side by side. Each has its own set of advantages and disadvantages that cater to different types of investors. Let's break them down one by one. Real estate can be a fantastic investment for several reasons. Tangible asset. Real estate investments involve owning physical property. This provides a sense of security because you can see and touch your investment. Unlike stocks, which are intangible, real estate offers a tangible asset that can be used or rented out. This is particularly appealing for those who value physical ownership over digital or paper assets. Passive income. Real estate can generate steady passive income through rental payments. This is not typically the case with stocks, unless you invest in dividend-paying stocks, which might not offer as consistent a cash flow as rental income. Appreciation potential. Over time, real estate properties tend to appreciate in value. This appreciation, combined with rental income, can significantly increase your net worth. While stocks also appreciate, the growth can be more volatile and less predictable. Tax benefits. Real estate offers various tax advantages, such as deductions for mortgage interest, property taxes, and depreciation. These tax benefits can reduce your overall tax liability, something not typically available with stock investments unless through specific tax-advantaged accounts like IRAs or 401(k)s. However, there are also downsides to consider. High upfront costs. Purchasing real estate requires significant upfront capital. This includes the down payment, closing costs, and often renovation expenses. In contrast, you can start investing in the stock market with relatively small amounts of money, making it more accessible to beginners. Maintenance and management. Owning property means ongoing responsibilities such as maintenance, repairs, and dealing with tenants. This can be time-consuming and stressful. Stocks, on the other hand, do not require such direct involvement, making them a more passive investment. Illiquidity. Real estate is not as liquid as stocks. Selling a property can take months, whereas you can sell stocks almost instantly during market hours. This lack of liquidity can be a significant drawback if you need quick access to your funds. Market fluctuations. While real estate markets are generally more stable than stock markets, they are not immune to economic downturns. Property values can decrease due to various factors, such as changes in the local economy or housing market. Stocks are more susceptible to market volatility, but this can also present opportunities for rapid gains. On the other hand, let's look at the stock market. High liquidity. Stocks are highly liquid assets, meaning you can buy and sell them quickly. This provides flexibility and easier access to your money compared to real estate. Potential for high returns. Historically, the stock market has delivered high returns over the long term. Investing in stocks of growing companies or sectors can lead to substantial gains. While real estate appreciates, the stock market can often provide higher returns, though with higher risk. Diversification options. The stock market offers a wide range of investment opportunities across different industries and geographies. This allows you to diversify your portfolio, which can help manage risk. Real estate diversification is possible but typically requires more capital to achieve. Lower initial investment. You don't need a large amount of money to start investing in stocks. This lower barrier to entry makes it easier for new investors to begin building their portfolios. Real estate investments generally require substantial initial capital. However, investing in stocks also has its risks: volatility and market risk. The stock market is known for its volatility. Prices can fluctuate widely based on economic conditions, company performance, and global events. This means that while there is potential for high returns, there is also a risk of significant losses. Real estate tends to be less volatile, providing a more stable investment. Emotional investing. The rapid changes in stock prices can lead to emotional decision-making. It's easy to get caught up in market hype or panic, which can result in buying high and selling low. Real estate investments usually require a more measured, long-term approach. Requires knowledge and monitoring. Successful stock market investing requires knowledge and continuous monitoring. You need to understand market trends, company performance, and economic indicators to make informed decisions. Real estate also requires knowledge, but often in different areas such as property management and market trends. Potential for total loss. Unlike real estate, which typically retains some value, a stock can become worthless if the underlying company goes bankrupt. This risk underscores the importance of diversification in your stock portfolio. Real estate, even in downturns, often retains some inherent value as a physical asset. Now that we've explored the pros and cons, let's compare the risk and return profiles of real estate and stocks. Real estate. Historically, real estate has provided steady returns with lower volatility. Properties tend to appreciate over time, and rental income can offer consistent cash flow. For example, if you purchase a rental property in a growing neighborhood, you can expect both property value appreciation and reliable rental income. However, you must account for the costs of maintenance, property taxes, and the potential for vacancies. Stocks, on the other hand, stocks have shown higher potential returns but with greater risk. The stock market's average annual return is around 7 to 10%, but it can be much higher or lower depending on various factors, including economic conditions and company performance. Investing in a diverse portfolio of stocks can help manage risk, but it doesn't eliminate it entirely. For instance, investing in technology stocks during a boom period can yield high returns, but these stocks can also be highly volatile. Ultimately, your risk tolerance and investment horizon will play a significant role in determining which option is better for you. If you prefer stability and long-term growth, real estate might be the way to go. If you're comfortable with taking on more risk for potentially higher returns, stocks could be your choice. Choosing between real estate and stock market investments depends on various personal factors. Here are some key considerations. Financial goals. Are you looking for steady income, long-term growth, or quick gains? Real estate typically offers steady income through rent and long-term growth through property appreciation. Stocks can provide quicker gains but with higher risk. Risk tolerance. Can you handle market volatility, or do you prefer stable returns? Real estate tends to be more stable but requires management. Stocks can be volatile but are easier to buy and sell. Investment horizon. How long can you leave your money invested? Real estate typically requires a longer commitment to see significant returns. Stocks can be more flexible and suitable for both short-term and long-term investments. Capital. Do you have enough upfront capital for real estate, or would you prefer the lower entry barrier of stocks? Real estate investments usually need substantial initial funds, while stocks allow you to start with smaller amounts. Market knowledge. Are you more knowledgeable about property markets or stock markets? Having expertise in the market you choose to invest in can significantly impact your success. Time and effort. Are you willing to manage properties, or do you prefer the hands-off approach of stocks? Real estate often requires active management, whereas stocks can be more passive, especially if you use automated investment tools. By evaluating these factors, you can make a more informed decision that aligns with your personal financial situation and goals. In conclusion, both real estate and stock market investments have their unique advantages and drawbacks. Real estate offers tangible assets and stable income but requires significant capital and management. Stocks provide liquidity and high return potential but come with greater volatility. Ultimately, the best investment for you depends on your financial goals, risk tolerance, and personal preferences. It's important to do your research, possibly consult with a financial advisor, and consider diversifying your portfolio to balance risk and reward. If you found this video helpful, Don't forget to hit the like button and subscribe to our channel for more investment insights. Drop a comment below with your thoughts on real estate versus stock market investing. Thanks for watching, and happy investing!